I actually think we're just getting started, and it's going to get much bigger from here. Crypto is a volatile asset. When you mix high degrees of leverage with volatility, you take on risk. I think for long-term investors, the important thing to note is it didn't change the trajectory, right? If you were my ETF investor, it closed on Friday when Bitcoin was at 117,000 US dollars, and then it opened on Monday when Bitcoin was at 115,000 US dollars. That's nothing. That's like a normal move. The whole weekend didn't exist. It really impacted short-term traders. Behind the scenes, we could dig into it. There were some infrastructure issues, there were some things that didn't work perfectly, but generally speaking, I think it cleared reasonably well. So this was an event that affected leveraged speculators, and it didn't affect the long-term story of Bitcoin. And I think we have to get used to the sort of those two markets coexisting.
Matt starts with a bold statement. The Bitcoin ETF phenomenon isn't a one-time event. It's the start of something huge. Why? Because, as he explains, ETF history shows a clear pattern. Year 2 is always bigger than Year 1. Year 3 is bigger than Year 2. The growth compounds. He gives a perfect example, the gold ETF. In its first year, gold ETFs saw about $3 billion in inflows. The next year, $5 billion. By year 8, those inflows peaked near $18 billion. Bitcoin ETFs are following a similar but even steeper trajectory. In their first year, they attracted around $36 billion in inflows in the U.S. alone. Matt predicts that in the coming year, we'll likely see $40 billion, then possibly $50 to $60 billion in the next.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
These ETFs events, was it a one-time event or will it just continue to grow? How big can it be?
Yeah, I think it's going to grow substantially. I actually don't think it was a one-time event at all, and there are two reasons for that. One, what's the first time you bought Bitcoin? Have you bought Bitcoin since? I think very few of us bought Bitcoin for the first time and never touched it again. For that reason, the people who already bought Bitcoin ETFs, guess what? I think they're going to buy more. But the bigger thing is if you look at the history of ETFs, and I come from an ETF background, it's always the case that year 2 is bigger than year 1, and year 3 is bigger than year 2, and year 4 is bigger than year 3. The gold ETFs, maybe the closest analog to the Bitcoin ETFs, they had a great first year, 3 billion inflows. Year 2 was 5 billion. It peaked at about 18 billion in year 8. Every sign I look at suggests that Bitcoin ETFs and other ETFs are following that same spectrum. So I know we did great last year. We had 36 billion in inflows in the US. I think we'll be at 40 this year. I wouldn't be surprised if we're at 50 or 60 next year. I actually think we're just getting started, and it's going to get much bigger from here.
And one question about the market, because right now we are in Barcelona for the European blockchain convention.
Yeah.
Just more or less a week ago, there was a really big crash in the market. Have you thought out what happened and why did it get so big?
Yeah, I think there was a lot of leverage that built up in the system. The open interest exceeded $100 billion on leveraged instruments for the first time in crypto's history. And crypto is a volatile asset. When you mix high degrees of leverage with volatility, you take on risk. I think for long-term investors, the important thing to note is it didn't change the trajectory, right? If you were my ETF investor, it closed on Friday when Bitcoin was at 117,000 US dollars, and then it opened on Monday when Bitcoin was at 115,000 US dollars. That's nothing. That's like a normal move. The whole weekend didn't exist. It really impacted short-term traders. Behind the scenes, we could dig into it. There were some infrastructure issues, there were some things that didn't work perfectly, but generally speaking, I think it cleared reasonably well. So this was an event that affected leveraged speculators, and it didn't affect the long-term story of Bitcoin. And I think we have to get used to the sort of those two markets coexisting.
So are we back on track on the bullish future?
We're definitely back on track. Look, that was a blip when you compare it to what's going on globally with rising interest in the debasement trade, concerns about the outlook for fiat currencies. You see gold at $4,200. You see global M2 at all-time highs. You see institutions allocating to Bitcoin. Those are much bigger forces than speculative traders losing money over the weekend. I feel bad for them. They suffered in some cases because of system faults, but it's not derailing this big story. This Bitcoin debasement trade is a multi-year story, and yeah, I'm very bullish into the end of the year.
Someone also said that it sort of proved the decentralized trend or solutions.
That's a very great point. Actually, the decentralized exchanges performed better than the centralized exchanges. The reason for that is that they're built to be in the most adversarial environment, and they're built with high quality code. I do think it endorsed the way we're going. Look, these are all stress tests. We're building a whole new financial ecosystem. We're talking about tokenizing all of the world's stocks and all of the world's bonds. That is the same system that we were testing this weekend. Did it work perfectly? No, but did it work pretty well? Given the scale and the volatility, I think it worked pretty well. And DeFi worked particularly well. So yeah, maybe there's a bullish case for DeFi out of this weekend. Yeah, I think it's great that they all exist. They all still serve different users. Digital asset treasuries provide sort of like leveraged exposure to crypto. That's great for a certain type of investor. Single asset ETPs are great for another type of investor. Tokenized or direct ownership may be better for a younger or more crypto native. The important thing is that everyone can access it in the way that they want. I think over time, you're going to see this market change and mature. On the ETP side, I think you're going to see more index-based solutions gain traction. On the tokenization side, I bet you'll see a lot of tokenized funds that combine equities and crypto. But again, there are all sorts of different investors out there. A sovereign wealth fund versus my uncle may want a different way to access the market. The great thing about what's happened in crypto is that now they all have their choices, and you just have to pick the right one for you.
In this industry, you could say that the retail led the way.
Yeah.
Maybe different from a lot of other industries, but are the institutions, are the wealthy investors, are they now on board?
They are coming on board, I would say. So we actually have a fun way of measuring this in the US, because we can look at our ETFs and we know from SEC filings what percentage of them are held by institutional investors, and therefore what percentage are held by retail investors. When they first launched in the first quarter, it was about 10% institutional, 90% retail. So even for ETPs, it was mostly retail. But that 10% is now about 28%. And it's on its way to being 50%. So they are coming for sure. That's clear in the data. But most of them still aren't here. It's still early. That will take a few more years. But I think we'll look at that number in a few years. It'll be 60 or 70% institutional.
How about earnings up double digits? It's been for the last few years. And when you take a look at next year's estimates, you can see expectations for revenue growth to continue, but to slow down. And I think the best analogy we have for this period, and none of them are perfect, the late 1990s period, remembering that 96, 97, 98, there were all sorts of warnings. This is over, the collapse is in, and we hear a lot of that again. I do think that we need to look at all these asset classes as a mature bull market. The S&P is trading at 27 times trailing earnings. But I think that the economy is actually poised to improve in the coming year. That's not going to, get us necessarily the same types of returns that we have. Again, it's next year's earnings really will matter, and the year after that. But these parts of the economy are growing now at a very rapid pace, and I think the rest of the economy has got some room to improve and to catch up.
Yeah, and that's exactly where I want to go with you. What do you think drives that improvement in the economy? How much of this is AI infrastructure? How much of this is something else?
Well, a lot of the strength in AI infrastructure is sort of out on its own. 42% growth, the most rapid growth rate since the personal computer was invented. But the rest of the economy has been held back. Construction has contracted. Industrial production in the United States has grown only 1%. You haven't seen manufacturing employment increase since March. But you take a look at that and you see consumer spending has grown 3.5% as of mid-quarter 3Q when the data were turned off. So there's been a lot of business caution. You can see it in 9 out of 10 industries in the ISM report are really concerned about tariffs. So we've taken a lot of hits across the world economy this year. If we stabilize in terms of macro policies, including trade, we'll see in the coming year producers will raise output a little bit faster to the demand pace.
Cracks in the credit market, scenario right now? You see that as an early indicator of something bigger, broader here?
Well, the longer we get into a recovery, the issues of easing credit standards will matter. As we just wrote in our CIO group outlook for 2026, we would not be investors in regional banks. We wouldn't be investors in the auto industry, right where you're seeing all of these issues. But let's bear in mind that a couple $2 billion of fraud is not exactly indicative of what's happened across the entire economy. I think that the worry that we've had about all of this, again, it very much tells you something about sentiment, that there are a lot of people who are still worried on the sidelines and thinking that it's all over. And that goes right back to repeating the pattern that we saw in the late 1990s before it became really excessive.
And we have the Fed in a blackout period right now. There is a large, we'll say, as close to certain as you can get in the market right now, pricing in an expectation of another Fed cut here in the coming days, coming weeks. How much of this hinges on that actually happening? And perhaps just as importantly, because I don't know that we've been talking about it as much as we should, the slowdown in the runoff of the balance sheet for the Fed as well.
Sure. Well, a couple points on that. When the Fed is cut more than 100 basis points, it's usually not good for the economy markets, the conditions that drive it. Now, there have been some exceptions. Again, the mid-1990s is a pretty good example. Again, didn't quite get to 100 basis points. But the bottom line are just recalibrating a bit, focusing in on the labor market, which has slowed gains to a crawl, and looking at that very differently from corporate profits, where we're going to get a lot of beats, and we're expecting in the coming year more than 10% EPS growth. So I don't think it really depends on the Federal Reserve cutting if they had strong reason to. If, all of the AI spending and the rest of the economy were going south, it would be a negative regardless of the cuts. Now, in terms of the balance sheet and that other question, I would just bear in mind that, the Federal Reserve has done a better job than it did in 2019. It was borrowing and lending at the same time. It's cut its securities holdings by over $2 trillion. And it's, again, I think can really been a little bit lucky here that the economy is normalizing a lot of the noise. We've got higher inflation rate than we otherwise would, but it's going to come down some in the coming year.
Matt also touches on the macroeconomic landscape shaping all markets, not just crypto. He draws an analogy to the late 1990s when people kept calling the end of the tech boom only to see it run for several more years. He points to major growth trends like AI infrastructure, which is expanding at a staggering 42% growth rate, the fastest since the personal computer revolution. Meanwhile, industrial production and manufacturing remain soft, but consumer spending is holding strong. He believes the economy is stabilizing, and if macro policies like tariffs and rates find balance, we could see a synchronized upswing next year.
You just heard my other thing about valuation per employee. Is there any part of the valuation spectrum for your companies that you cover that worries you at all?
Well, let's see. We have had a major re-rating. I mean, we're 3 years into a tech boom here, at least in the consumer internet stocks that I look at. We've had a really dramatic rally in these names. There were very interesting entry points. I thought earlier this year on Uber, earlier this year on Google, and I'm sort of struggling to find those great entry points on names now. They're good compounders. I think Meta is a great compounder at 23, 24 times earnings. I think the valuation is very reasonable versus the market, but it's not dislocated in the way that I really like to hunt for stocks. Amazon may be the closest I have to a dislocated stock, despite today's outage. I think it's actually one of the it's underperformed year to date, which creates the opportunity if they can get AWS growth to accelerate. And I think they will. I don't think today's outage really impacts that. I hope it doesn't. I don't think it will.
I've dislocated my shoulder. I've never dislocated a stock. What does dislocated stock mean, Mark?
Well, it's what I hunt for. It's DHQs, dislocated high quality names. So stocks that trade off 20 to 30% or trade at a discount to their growth rate. You had that with Uber at the beginning of the year. You had that with Google when it was trading at 15 times earnings. If you got a high quality company that's generating earnings in line with or faster than the market, but trades at a discount to a market, that to me is dislocated. There's a little bit of art in there. There's a lot of science behind what's dislocated. So stocks that are generally trading well off their highs or their recent highs, and there's just not that many of those in the internet space or broadly in tech right now.
Does the brief Amazon Web Services outage that you referenced that we've talked about, does that change anything?
I don't think we know yet. AWS has had large outages before in the last few years. A year ago, they had a 7-hour outage. I don't think this is going to be as long as that, but the AWS is so key to so much of internet infrastructure that a lengthy outage like this, in a time when AWS is perceived to be losing share, and it is losing share to other names like Google Cloud and Azure, this certainly doesn't help. So in order to win that incremental client, they better recover fully and quickly. So at the margin, it makes it a little tougher.
Stock's not impacted at all, at least. I mean, I shouldn't say that. It's up 1.3% right now. Maybe it would be up more, but for this. You heard our kind of fun exercise in the segment before. We talked about some of the rare earths, but we highlighted Apple and NVIDIA. We weren't picking on those companies. They're just some of the biggest in the world, and they're in the news, so we threw them out. Is $123 million in valuation per employee? I mean, obviously everybody needs a raise there, Mark, but does that trouble you at all?
Sure, it does. What I've focused on, though, is first I focused on the fundamentals and look at what's happened to revenue per employee and to operating income per employee over the last couple of years. I referred to it as ROAI, return on AI spend. And if you look at the 4 major hyperscalers, Microsoft, Amazon, Google, and Meta, they've inflected up. Their revenue per employee all of a sudden gapped up beginning in 23. And operating income per employee gapped up. Now, there's a lot of variables that go into that. And part is that these companies have just gotten much more aggressive about managing headcount. But there's no doubt in my mind that you've seen these companies deploy AI and it's materially improved the productivity of each of their employees. So I look at the fundamental trend first. And then when it comes to the market cap, I could do a lot of funny things. Look at the PE. And if I see a name like a Google and a Meta trading at a modest premium to the market for what I think are kind of enduring consumer utilities, I think valuation is very reasonable. So I'll stick with my guns on those. I look at the major tech names. I don't see the 50 to 100 PE multiples or higher that I saw way back in the dot-com bubble.
Matt addresses the conversation about tech stock valuations. Yes, some big names like Apple and NVIDIA look stretched when you look at metrics like market cap per employee. But Matt looks deeper, focusing on return on AI spend. He notes that companies like Google, Meta, Amazon, and Microsoft have all seen a clear inflection point. Revenue and operating income per employee are rising sharply, largely due to AI-driven productivity gains. So while valuations are high, the fundamentals are improving too. He's not seeing the same bubble conditions as the dot-com era. Instead, it's a re-rating of the digital economy, built on tangible earnings and new technologies.